It's now the middle of November already. We're looking at 2025 today. We have lots of really interesting fourth quarter housing market activity and a bunch of signals already for 2025. So we're going to dive into all of those things today. As always, love to see in the chat where you're connecting in from. We have a big crowd today. Everybody's interested in what's happening next year. We will record the webinar, so you will get a webinar later. And also in the chat, you'll find Jeff and Lael from the Altos team. They will share links and other questions along the way so that you can make sure you get all of the stuff we're referring to as we are going through. I stick around at the end of the session to make sure that any last questions are answered, and we will get rolling. Before I dive into the data, I have two announcements today. The first one, of course, is the free Altos ebook. So all of the data that I'm reviewing today, if you need to be able to communicate with your buyers and sellers, with other participants in the housing market about what's happening, I encourage you to go get our free ebook. This has scripts, it has scenarios, it talks about the data. It helps you understand how to talk about the housing market. And it uses the data that I'm talking about here today. If it's free, so go click through that. There's a link in the chat that you can go click through and download that if you don't already have the free ebook. The next announcement before we dive into the data is that as of today, we have the 2025 housing market forecast full research paper from the team at HousingWire Research. This is like 40 pages of data and charts and analysis about what we know, about the scenarios, about what may be coming. It's available to HousingWire subscribers. You can go to housingwire.com research. We'll post the link in the chat so that you can go click through and get that. You can get that from your HousingWire account. And I'll share some of the data here today and some of the conclusions. And then if you want to be able to look at all of the insights, all of the data, figure out how your view of 2025 shapes up, I encourage you to go get that paper. I think that's going to be really useful for a lot of people. It's got a ton of information. We have a bunch of input from a lot of the experts at HousingWire, including Logan. I have stuff in there myself. It's a lot of great data and a lot of great view of 2025. So for today, the big questions that we are going to tackle is, a month ago when we did this webinar, it looked like sales were recovering. Rates had come down and we could see that first inklings of home sales recovering, and now suddenly mortgage rates are back up. And the question is that it? Like, was that the recovery? We're going to see what we know and what we can see for 2025. We're going to look at inventory, of course, as we do. And when we look at home prices, we know about what home prices are doing right now, but also what we can forecast for 2025. So those are the big things today. As always, we're going to dive into the local data. I can't always get to every local market. I have a few interesting ones that are up. If you want to review your local market, the best thing to do is book a free consult with our team. Go to Altos, book a demo. You can talk with Jeff or one of the other people on the team about your local market and how to use the data to talk to your clients right now. So if I can't get to your local market, go book that time with Jeff or one of the other people on the team, and you can dive into your local market. All right. So starting with mortgage rates today. In this view, we have 13 years of mortgage rates. The further to the left was the lower the rates were, and you can see the distribution over each year of where mortgage rates landed. Each dot is a week of the average 30-year fixed rate for that week. So most of the decade, mortgage rates were in the 3s and 4s. 2022, we had that big increase. 23 had that we hit 8%. And now at the bottom of the chart, we have 24. I think the most interesting thing about this view is where we are today. We are today just under 7%. It is higher than rates have been for most of the year. It's higher than rates were for most of last year. It's higher than rates were for essentially all of 2022. And so that is a rebound of over the last 6-8 weeks. And 8 weeks ago, we were at the lowest point in mortgage rates for the year. We were close to 6% on the 30-year fixed. And at that point, we could see sales activity starting. So we are now on the other side of that, and we're rolling into 2025 with weaker momentum because of the higher cost of money. So that's going to be the big thing to keep our eye on. In the last 2 years, mortgage rates spiked in the fourth quarter, just like they did this year. They peaked at the end of November and started coming down into December into January. So maybe if we're lucky, we get that again. If we're not lucky and rates stay at 7% or go into the sevens, then that will have a direct impact on the range of the forecast that we can see for home sales and for home prices in 2025. And if you look at that forecast document, the way we have it set up is there's two big numbers that we're looking for in the future. There's home prices, which consumers care about. Home buyers and sellers care about the prices. Are prices coming down? Should I wait? Are they going up? Should I jump in now? Those are home price questions. The industry actually cares more about home sales. Will we finally get more home sales in 2025? The answer on the home sales question is our forecast is for about 5% home sales growth in 2025. So going from, say, 4 million, a pace of about 4 million home sales this year to about 4.2 million next year. If you look at a bunch of other forecasters like NAR is forecasting a lot more home sales than that. We think it's unlikely that we'll get a lot more home sales for a bunch of reasons. Number one is we're rolling into the year with higher mortgage rates already. Number two is that it is very rare that home sales grow more than 10% in a given year. It would have to be a dramatically strong year for home sales to grow from 4 million to, say, 4.8 or 4.9. 20% home sales growth in 1 year is a big deal. It would take lots of government intervention, big programs, maybe a dramatic change in the economy. So we do expect some home sales growth in 25, but like 5%. 200,000 more homes. And I think that's the first year in 3 that we've had growth. So that is a little optimistic. Now, when we look at, so mortgage rates are up. And when we look at an affordability metric, we can look at how much people are paying on their mortgage payments right now. This is taking that current mortgage rate. It's taking an average 8% down payment, and it's using the 30-year fixed rate of the current week. So we can see the dark line for 2024 peaked in May, right? That's when mortgage rates were at 7.5 and home prices were up. Last year, the red line over here peaked in November because that's when mortgage rates hit 8%. So now you can see in the 2024 line, September lows, we were starting to get below 22. Payments were almost going to go below the cheapest in 2 years, but rates turned and started climbing again. And so that is a weak signal for home sales in the coming quarter. People recognize that. So 2 things can happen to bring this line down. Home prices can tick down or interest rates can tick down. And so either of those will help make home prices or home payments cheaper. Now, What we're looking at here is really this is a function, this rise in the last 2 months is a function of rising interest rates. That'll be a big knob. Home prices in general have not fallen. They're up about 3 to 5% across the country this year. So this is the payments are up as well. We could see the change in activity, buyer demand kicking up when this payment line started coming down below the 2022. That range was starting to see, we could start to see activity. So if we get lucky and rates come back closer to 6 or into the 5s in next year, that's when we expect to see some demand activity accelerated. All right, so that's the mortgage rate scenario. Let's look at inventory. There are currently 722,000 single-family homes unsold on the market across the U.S. That is 28% more homes on the market than a year ago. If you remember this webinar in September, 2 months ago, there were 40% more homes on the market than 23 at that time. So now there's 28%. What that means is inventory was climbing faster a year ago. And it is that, so the compression growth over last year is shrinking. That means we grew closer to the old normal. 2019 up here used to have 800, 900,000, a million single family homes unsold on the market late in the year. And now we have 722,000. Next year, we expect, well, I'll get to the forecast of that. Next year, we'll expect growth of another 13%. We're going to get closer to the to the old normal pandemic numbers. And that's assuming that rates stay in this, around in the 6s next year. So they're currently 722,000. Inventory ticked down this week with the election week, and I think it's going to rebound a fraction next week when we do the data, and we'll see it in a few places. We took a bit of a breather for the election week this week, but we will see that we can expect that inventory and things will rebound a little bit for next Monday's data. So new listings, there are roughly 49,000 new listings this week. It actually ticked down a bit. Say the red line dipped down for the election week. But in general, we've been having more inventory, more new listings each week than a year ago. So over the past few years, mortgage rates are up. I'm locked into my nice low rate. The whole sales have been down. Home sales have been down. New listing seller volume has been down. Things like job changes are down. So job quits are down. Hiring is down. So unemployment is very low, but people are not quitting their jobs and starting new ones. We're not moving. We're not moving across town, and we're not moving across the country. All of those things have kept transaction volume down. But each year, we get slightly more new listings. So a week ago, there were 17% more new listings than last year, and we've been averaging about 5 to 10% more. Next year, we should expect that growth as well. So 5 to 10% more sellers each week gives us a little lift in total number of sellers. It gives us a little lift in total number of transactions that can happen as the market slowly normalizes post-pandemic. In the new listings line here, so the gray lines are previous years, the red line is this year, and there's some bounces week to week. What I'm watching for is there's a bearish scenario for the housing market. If we get to a place where, let's say, unemployment rises, people need to sell their homes, or they get it distressed, and those go into foreclosure, any of those scenarios, investors that get discouraged and want to unload homes, those are the scenarios that would surge inventory, that help inventory grow. And then if inventory grows a lot, you get a supply and demand imbalance. That would have implications for home prices. In order for inventory to grow a lot, we need to see this red line start trading in the high range of all the grays as opposed to the low range of the grays. So you can see January, February, March, April, May, as many 80,000, 90,000, 100,000 single family homes listed in a given week. And this year we had 50, 60, 70,000. So next year, and as we get to the fall, we'll see it bounce in the midst of the spaghetti over here on the far right. Then we're going to start 25 on the left side of the chart. And if the sellers, the new listings each week are in starting at they're plotting in the higher set of the gray lines here, old normal levels of sellers, that is going to be a signal for more sellers, more inventory build. If it goes above those old lines, that's when we would get into a scenario of maybe too many sellers, which would have bearish conditions on home sales. In the data now, there is no evidence of too many sellers anywhere, but that's what we keep watching for to know when the market changes. Hasn't changed yet. Okay, so that was a new listing volume. When we look at inventory at the state level, there's now 28% more homes unsold across the country. And so you can see the redder the state, the more inventory build versus last year. What's interesting about this view is, so Arizona here at 52% more homes than on the market a year ago. 2 months ago, Arizona was 70% more homes. So what happened was in 23, inventory was piling up much more quickly than it is now. So we're now at 52% more homes in Arizona. We were at 70% more, now it's 52% more. And then next year the gains will be less. We'll continue to have more gains and more homes on the market, but the gains will be even less. The redder the state here, the more inventory gains from the previous year. And you can see it's generally redder across the Sun Belt, and the Midwest and Northeast is generally lighter. So, Illinois, 10% more homes on the market than a year ago. Illinois is barely more than the pandemic lows of available inventory, where Texas is at decade highs. Arizona is about the same. Florida, it's like those markets are significantly higher than they've been, but last year it was growing faster. So it's a little bit of a stability in that. So what this tells us is that we're not looking at next year to have 100% home inventory growth. We're going to have 13%, or we'll have a slightly narrower view. So here's the projection. To finish the year, we're going to finish at about 655,000 single family homes unsold on the market. There's 722 now. And of course, as you get over the holidays, there's fewer and fewer home sales. That resets after the holidays. So the dotted line is how we project the rest of the year. And it will end the year with about 27% more homes on the market than a year ago. Then we look at 25, and here's how we're projecting for 25. Remember, the growth over the previous year is compressing. That compression continues to happen, so that we start with 27% more homes in January, and then at the right end of the chart, we finish with about 13% more homes on the market. This assumes some stability in mortgage rates. So we are assuming in our forecasting that rates stay absolute peak at 7.25, probably absolute low is 5.75. So in that range, and that, we've had a 150 basis point range in 24. You can imagine a big range in 25 again. And that so that allows for, there are some months when the economic data is good and the rates, the yield on the 10-year Treasury falls, mortgage rates fall, that spurs demand. There are some weeks, some months when that data is opposite and it pushes rates higher. So you get a natural fluctuation during the year. We are not assuming in our forecasting any big recession, and we're not assuming any dramatic drop in mortgage rates. So, for example, a year ago, there were people in the industry who would say 2024 was going to have 5% mortgage rates, it was going to have 5 million home sales. And what we're looking at is like that didn't come anywhere close to happening. And we don't see any signal that it's ready to happen yet. So we think slightly better, slightly lower average rates all year in 25 than 24, but there's no catalyst we see for a major drop. If we were to have a drop of, let's say the economic data came in weak, mortgage rates fell, interest rates fell, mortgage rates fell, that spurs a bunch of demand. When rates fall, it spurs demand faster than supply. And so that would actually, if rates were to fall, that would bring this projection of inventory down for the year. And we could actually have finished the year with less. So if we spend any time with rates at like 5% during the year, expect inventory to shrink in 2025. But our forecast for now is for about 13% inventory growth over 24. We're getting closer to the old normal levels like 2019. Let's switch to home sales. We're now averaging about 10% more home sales than a year ago. In the fourth quarter of 22 and 23, sales were especially bad. Those were the times mortgage rates spiked from 6 to 7.5 in 22, and in 23 they spiked from 6.5 to 8 in the fourth quarter. Now this year they've spiked from 6.1 to 7. Not quite as big a move, but it's a big move, and it's getting expensive, as I illustrated that first slide. So we're now averaging about 58,000 new home sales pending each week. And so it is a slight improvement over the last 2 years in the fourth quarter. And the fourth quarter of the last 2 years were especially dismal. Now, so what we're doing here is these are newly pending contracts in a given week. House is listed, takes an offer, it goes into contract, it's pending. Homes are really, they spend 30 or 40 days in contract on average. So these are sales that are newly pending now in November. They'll close some in November, mostly in December, and those will get reported in January. So I believe by December and January, we'll start to see some positive home sales prints, home sales growth. But the other thing to keep in mind is that as rates jumped back to 7%, we can see that slowing this growth down. And so this growth maybe is fleeting. We've had some home sales growth. It's going to come out in the headlines, but it could go away very quickly if mortgage rates stay around 7 or move higher from here. So those are the things to keep in mind. I think the good news with our home sales growth is that we can see some growth. I think we're going to see it in the headlines, and it sets us up for a little more sales growth next year. So as I mentioned, we're forecasting about 5% home sales growth in 25. So go from 4 million to 4.2 million home sales next year. And we can see it starting here, but it could be fleeting if mortgage rates spike. So that's where we are on the new contracts pending. And when we look at the total set, so now these are all of them that sit in contract for a month. There are 336,000 single-family homes in contract now. We are above 22 and 23. So there are more homes in the contract pending stage than there were in November of the last 2 years. But look at the light line, the light red line here. The 22 line is, see how many there were: 400,000, 450,000 homes, single family homes in contract at the peak at the peak of 22. And then those sales completed in the second half of the year, and we didn't add many more in. So you can see we're still very low on the home sales front. You can see the dark line, the curve, the slope is less dramatically down than the last 2 years because the last 2 years were really rough in the fourth quarter. So the good news is that the comparisons over the last 2 years is a lot easier. So that's the total sales in the pending process right now. So fourth quarter is going to be a little better than the last two fourth quarters. All right, let's switch to pricing. So this is the all the homes on the market around the US. The current ask price is the median is $434,900. So if you go to buy a house today and you look at all of the homes in the US, this is what you can choose from. You can see a bunch of different signals in this data. We can see how this year, the dark line for this year has a much slower slope. The spring was slower on the upside. The fall is slower on the downside. And so we have a couple percent price gains over last year that's shaping up in the last 6 weeks of the year. So home prices by this measure are finishing the year up maybe 2-3%. So this is looking at all the homes on the market. When we look at the new contracts, so these are the ones going into contract, the price point that people are buying is $380,000. So this week, those 51,000 single family homes that went into contract, the median price was $380,000. It was a downtick for the election week here, so there's a slight downtick. I think that's going to rebound next week, probably back up to 385. And what that is about a 4% or 5, it's been in the 5% home price appreciation range over 2023. And the headlines, things like the Case-Shiller or the NAR headlines, will finish the year showing about 4% home price gains over last year. The thing that I found really interesting here was starting in the middle of the year, we knew that in June of this year, the demand was weak, rates were higher for longer. We did not see, even as rates fell from 7 down to 6.5, we did not see much action. And at that time, I was expecting this curve of prices to finish down where they touched the same in September here. And I thought that curve was going to extend. What we found was at that September moment when mortgage rates got close to 6, we saw buyer demand tick up. We saw the price stabilize that people were willing to pay. And so prices ticked up and stabilized at that point rather than continuing to decline. So that changed us from a 0% home price gain for the year to about a 4 or 5% by the time we finish the year. So that's what we're looking at for 2024. And these are looking at the homes that are going into contract. So these are the price that people are paying. And you can see in 22, the big drops in June and September, those were the big mortgage rate spikes that were first rocking the market. We are now much more used to it. And the rule of thumb that I say is consumers are more sensitive to changes in mortgage rates than to the absolute levels. So in 22, rates went from 3% to 7.5%, and that really dropped the pricing down. Now we're at 6.1, and we go to 7, like that impacts, but not nearly as much as the big. So consumers are more sensitive to changes in rates than to the absolute levels. And when we look at the state level, I think this is a very powerful illustration. These are home price changes versus last year using that new pendings price. And you can see the Sun Belt. These are the states that also have more inventory growth, there's significantly less demand and bigger supply. All of these, if you're within 1 or 2% plus or minus, those are essentially home prices unchanged. There are markets in those states where home prices are down year over year. There's some where they're up a little bit year over year, but all of these, Texas, Florida, Georgia, South Carolina, all of these are roughly flat. But then you look in the blue states, those are where the bigger home price gains are year over year. So New Jersey is leading. You have Ohio and Michigan. You have those states. Massachusetts and Rhode Island have Massachusetts was one of the stronger. Boston was one of the stronger markets all year. So you can see where that is, and the dynamic happening here is for the last 15 years, people moved out of Illinois and they moved to Florida, or they moved out of the Midwest and they moved to Arizona or Texas. And over the last 2 years, 2.5 years, that migration flow has stopped. So we build a lot in Texas, we sell in Illinois, and we buy in Texas. And when we have stopped moving, we've stopped selling in Illinois, and we've stopped buying those in Texas. So there are fewer homes for sale in Illinois. There are more homes for sale in Texas, and that inventory supply demand imbalance means that inventory is still super tight in the Midwest, and prices are more resilient in the Midwest. Inventory is much looser in the Sun Belt states, and prices are much weaker in the Sun Belt states. So that's the illustration. You can really see the pattern, the migration pattern there. When we look at the forecast for home prices for 2025. So as I mentioned, we've been in this 5% home price gain range. And this is using that pending sales price from the year prior. You can see a period of 23 when home prices went negative after that really dramatic fourth quarter of 22. And then they stabilized. Last year, home prices finished up about 4%, and they've been bouncing in this 5% range all year long. Now we've done our forecast. We're forecasting a 3.5% home price gain for 2025. Normal, if you think about the last multi-decades, 80 years, normal home price appreciation is about 5% per year. And we get 5% home price appreciation because of a bunch of things. One, in the US, we really encourage home buying. Two, we underbuild. So there are more people that want to buy. That drives, we have economic growth, we have population growth. All of those things lead to about a 5% home price gain is a normal year. So we're forecasting for next year 3.5% gain. That means weaker than normal, less home price appreciation than normal. Now, I participate in a survey with a firm called Pulsenomics. They survey 100 economists and housing market forecasters about their forecast for what's going to happen for home prices in the next few years. Pulsenomics does this with Fannie Mae, and we're forecasting the Fannie Mae data. So what we're looking at here, so of those 100 people, there are some folks who think that home prices are going to gain 8% next year, and some folks are going to think that they're going to drop by as much as 5 or 6% next year. The low forecasts here are generally based on affordability. So how we have an affordability crisis, and the price to income ratio is probably 20% too high. And so the folks who are forecasting that very low, like home prices drop in 25, those folks generally are the ones who are assuming that the affordability must get back in line. The ones who are assuming the other side, the high, are folks who are saying that, well, 5% is baseline. We still have a shortage of inventory, and I think rates are going to drop from here, and that's going to spur demand. So you get a big range in expectations. Our forecast at Housing Wire is 3.5% home price gains next year. That is based on, no recession. It's based on rates staying in the 6s to 7, and slightly and continuing to grow inventory. So because we have more supply, that it keeps a little bit of a downward pressure on home prices. Because we will have continued on affordability with mortgage rates, that'll keep a lid on. So on prices. So our forecast is about 3.5%. This is in the forecast paper that I mentioned at the beginning of the session today. You can go to Housing Wire Research, and we'll post a link in the chat, and you can download. Housing Wire subscribers can download. It's a big 40-page paper with all of the things, including our home price gains and a look at everybody else's. All right, let's look at some of the leading indicators, and then we're going to switch to the local data. So there are now 38.8% of the homes on the market that have taken a price cut. And we use these price cuts as a leading indicator for future transactions. The normal range for price cuts is about 30 to 35%. About a third of homes take a price cut before they sell nationally. And so when more of them do, when we're at 38, that implies weaker demand than normal, than what sellers would expect. When the lines are below, they're down here in the 19, that means 35% of homes were overpriced, thought they were overpriced, but some of them were fishing for offers and they got their offers. So there was enough demand, there's overbidding, there's bidding wars, there's enough demand. So we've had high price cuts all year long, and that's been a weak signal. It's one of the things that's kept a lid on price appreciation. But in the last few months, those price cuts have plateaued. Two things are happening here. There are two ways to get fewer price cuts, a lower percentage of the market with price cuts. One is that the house gets its offer and it goes into contract. The next is three ways. We'll go to three ways. The next is there's homes that are on the market. They do a price cut in September. They still don't get an offer in October. They withdraw the listing in November. Now there are fewer homes on the market with price cuts because those guys withdrew. And you can look at that withdrawal rate through two lenses. One would be that's very bad. There's no buyers, and I withdrew my listing, and therefore that's a bearish signal for the future. The other way is to look at it in kind of an optimistic way, which is, as a seller, I have my listing. I don't get the price I want, and therefore I'm just going to wait, and I can afford to wait. And so when so what we're seeing here is a phenomenon in home pricing called downside stickiness. Sellers are reluctant to lower their price, to sell at a value lower than they thought they should get. And because homeowners have a lot of equity and they have very low rates, they're in a very strong position to wait. Now, and so you withdraw the home, and so price reductions goes down. That house with a price cut is no longer on the market. So what we're looking at, though, is so there's 38.8%. That's fewer. We have some home sales completing. We have new sellers who are pricing at the proper level, and we have some withdrawals. So all of those are conspiring to keep a lid on price reductions. In the last 2 years, the two red lines here, you could see price reductions kicking up as mortgage rates spiked in the fourth quarter. You can see them very dramatically at these September inflection points, September through the end of November, when mortgage rates spiked in both of those in the last 2 years. So this is a signal that we don't have dramatic price decreases going into next year. In other words, the sellers that are on the market have their expectations in line for what buyers are paying. And we don't have a dramatic change that will drive home prices lower next year. The dramatic change you can see in the 22 line really went from record low to high in 1 year. That's the sellers that were getting surprised. And if you remember, once we hit this November level of 43% homes with price cuts around the country, that meant that by the spring of 23, we had year over year home prices declined. So that led the price declines by about 6 months. So this is now plateaued and is not driving higher. That leads future transactions and prices by about 6 months. So it shows price stability in the first half of 2025. That's the view we have. Now I'm going to switch to the local markets, and we have some real interesting things going on with price reductions at the local level right now. This is the Altos platform. I'm in the advanced analytics section in my account. I have a chart built which ranks the 50 metro markets with the most price reductions. And if you remember, if you've been on these webinars each month, you'll know that most of the year, the Florida markets led price reductions higher. But right now, Denver is back up at the top. So Denver is one of those inbound migration markets where people move from Illinois to Denver. They stopped moving in the last couple of years. So inventory is building in Colorado. And because inventory is building, price reductions are building as well. Like that's a price weakness signal in Colorado. And during the peak of the frenzy, only 10% of the homes, 9.5% of the homes in Colorado and Denver had price cuts. Like a third thought they were overpriced, but 9.5 had to take a price cut because everybody was being bought. And now we're at 53%, the most in the country is right now in Denver. So Denver is setting up very weak. Austin has, what's interesting in Austin is that they are past their peak and are starting to tick back down. We have some Indianapolis and Charlotte, which are actually working their way back up. Tampa is a special space because of the hurricane, and I'm going to take a look at Tampa in the deep dive here in a sec. We have the other one I have up is I'm watching Dallas, Texas inventory rate, big inbound migration market that stopped. So I've got Texas 2024 compared to the 3 years before the pandemic. And you can see how we have far more inventory unsold than we did in those recent years. And that is why Dallas has, for example, one of the weaker price pressures around the country right now because that many homes are for sale in Dallas. We had a downtick this week. We'll see if it bounces up after the election data comes out, but it's going to decline for the fall for the rest of for the holidays, and then restart next year with a lot more homes on the market. We're going to see where Dallas ends up during the year. All right, I'm going to go to Tampa first. So Tampa has had the hurricanes, and we can see what the hurricanes did to inventory in Tampa. Inventory was rising all year and then dropped over a couple of weeks down. About 10% of the homes that were available in Tampa are now off the market, and it's a slower rise and will start declining. And I think this is a really notable change, and it's an important change because people ask, did the hurricanes lead to a flood of people selling to get out? And what turns out they did is and I'm zoomed in. This is just 1 year of data here. I can zoom way out. And so what we can do is look at 5 years. We can see that there are more homes on the market now than there were pre-pandemic, way up off of the pandemic lows. And we can see this dip after the hurricane. What I expect, though, is next year, this is going to drive higher. So next year, the hurricane fades into the rearview mirror for people out of town, but it still remains prominent for people in town. And so I expect that next year we're going to see inventory drive higher in Western Florida, in places like Tampa and Sarasota. We can see that the market is pretty evenly distributed, only a little faster at the low end than the high end, the most expensive stuff in Tampa. We'll compare it to other markets where there's a big dramatic change here. Okay, let's go to Phoenix. Phoenix is a fascinating trend. Phoenix when the market turned in 22, Phoenix was one of the hardest drops. So this is the list price in Phoenix. You can see dropped dramatically in 22, so that by 23 there was year over year price declines. But Phoenix recovered very quickly in 23, surprisingly fast. To me, this was a signal of a lot of cash on the sidelines, investors waiting, and prices got to a certain point, and investors put a floor on home prices in Phoenix. We now have another year of growing supply, sliding prices a little bit. So home prices are down year over year in Phoenix. And what I anticipate is that next year we have less and less of that pandemic cash reserve. We came out of the pandemic with so much cash that we could do things like buy a home. And so I expect that this downward pressure in a place like Phoenix continues in 2025. It's one of the reasons why we don't see a catalyst for home prices to grow more nationally, more than 5%. We think it's more like 3.5%, because there are going to be markets like Phoenix where there is downward pressure because there's simply less cash on the sidelines. We can see, though, compared to Tampa, things still move at the right price point, the right properties in Phoenix. This 400, 300, $400,000 is a buy box for a lot of home buyers. It's a buy box for a lot of investors. And you can see that that's where the action is, fewest days on market at that price range. If we look at inventory in Phoenix, you can see that we are at multi-year highs in inventory. We're more homes on the market now than 2 years ago, and so that is that negative pressure that I was describing. I talked about Colorado. Let's look at Denver in close up. So in the Denver metro market, we can see that we are at multi-year highs in inventory, significantly higher than the pandemic, right? We were at 900 homes in the whole Denver market, and we're now at 7,000. That's a big difference. And tick down for the year, and you can see the strong seasonal curve in Denver. So that's on its way down for the season, and we'll start climbing again in March. But significantly more homes. And as we do that, then we look at that price decrease window. And so we're now at the most price decreases in the whole country. But 2 years ago, we were at 60% of the homes on the market in Denver. So this was that dramatic, like the big shock for everybody, went from 9% to 60. Right now, we're at 53. So it's not as bearish as it was 2 years ago. 2 years ago led to negative home price changes by March. This one is looking like flat. We finished the year up 3.5% nationally. I have Washington, D.C. up as a little bit of a counterpoint. So when we look at the inventory, unsold inventory of single family homes in Washington, D.C., we can see, like, here are the pandemic years. This is a very different view from Colorado. We have barely more homes unsold than the last few years. Still very tight of inventory. The market action index is significantly higher, and this speedometer here is supply versus demand. So the higher that goes is the tighter the market. And so in the DC metro, you can see exactly that. We can also see the high end, the $2 million high end in DC compared to the under $500,000. You can see exactly where the demand is in DC. We can look at the price trend over time. So home prices in DC are up fractionally year over year, right? So this is a very different view than the Phoenix, Dallas, Tampa, Denver views that we've been sharing. And so you continue to have strong economy, you have inbound migration, you have tight inventory, and these are the things that lead to continued price resilience. So, if you're a realtor in Austin or, Western Florida, it can be very interesting or very tempting to say, wow, the housing market is tanking. And nationally, we have very different trends happening. one of the themes for 2025 is that I see this bifurcated market normalizing. So we had the strong north. I did the map with the northern part of the country had home price gains. The southern part of the country has home price flattening. That's because we stopped moving. And I see in 2025, we start moving a little bit more. So inventory normalizes a little bit more, a little higher in the north, a little lower in the south. So they start normalizing a little bit. And therefore, prices do the same. We get a little more smoothed out of all of those trends in the next year. I've got a few states up, but let me just switch back to our slides and here, and then just to give it a wrap up. As I mentioned, we have the free ebook. I don't have a chance to get to all of the local markets here, but you can use the free ebook to learn how to talk about the data, to get some scripts, to talk to your clients, to understand what the data points mean. All the stuff I talk about is in that ebook, and there'll be a link in the chat. We also, if you want to review your local market, go to Altos Research, book some time with our team. You can review exactly what we've been doing with your local market and figure out how to get set up to do that, to get the market data into your client hands right away. I've been talking a lot today about the forecast. We have just published, we're publishing today, the Housing Wire 2025 housing market forecast. If you're a Housing Wire subscriber, you can get that big document. It's like 40 pages with a lot of data and all the logic for how we view what's going to happen in 2025. That's available today. We'll also follow up, after the recording, we email this to everybody, and we'll put a link in there where you can download that forecast for 2025, get all of those, and that's for Housing Wire subscribers. So stick around and make sure you get that. Okay, everybody, that's it we'll have one more webinar in December before we flip over the holidays. I'm going to stick around in the chat. The webinar was recorded. We will send it out to you as soon as it's available today. Everybody, have a happy Thanksgiving. We'll see you in a month.